today I'm speaking to George Waffel of Pricewaterhouse Coopers, and we're going to talk about social media and banks. So, how can social media really change the future for banks?
Well, actually, social media is the future of banks. Banks understand that they operate in and lend to and make payments for a community. What they don't understand, many of them, is that social media is the new community. In the early days of the web, everything was one-to-one. I could go to a bank's website, but it was that bank's website. It wasn't a community website. If I sent email to somebody, it was a one-to-one message. Even one-to-many, all I could do is distribute my message. I couldn't have a conversation. What you can do on Facebook and other social media is have an actual conversation. That makes it a community. There's a sociologist at Oxford named Dunbar who's famous for Dunbar's number. Dunbar's number is 150 because it turns out that from the early 1400s to today, that's as many associates as any of us can have. It also turns out that was the number of people who lived in a European village around 1600. So nothing's changed. What's changed is that community is no longer physically located somewhere. It's no longer geographic. It's in the cloud. So the impact of social media on banking is simply one of understanding an entire new community to serve. What I like to say to banks is, if I told you there were 900 million people without a bank, would you want to be there? It's up to 1 billion now, and that's Facebook.
What about opportunities for partnerships, especially with sort of mobile networks and retailers, to really take advantage of mobile payments?
The first thing that banks and credit unions need to understand about partnering is they have the upper hand in negotiating a partnership with a telecoms company or a technology company. That's because people trust financial institutions to do these new media payments, whether it's mobile or social media. Surveys by Pricewaterhouse Coopers and others have shown that between 60 and 70% of people say they prefer that any kind of new media payment move from their bank to the recipient's bank, whether the recipient is their daughter at college or a merchant. They don't want the payment moving between these non-bank types of institutions. So that gives the bank institution, the credit union, a real advantage in negotiation. The second point is there's really a spectrum of partnerships. At one extreme, there's what's the minimal partner I need? You really need a phone company, but you don't have to have a partnership with it. You can just run your messages across it. I think a partnership probably works well. There's a big bank in Canada who just got together with the biggest mobile payments company in Canada, and they formed a partnership to do NFC. But beyond the telecommunications partner, how many other partners you need is up to you. You can do all the rest yourself. At the other extreme is having a pool of partners, and then you've got a management problem. A third option is to outsource it all. Go to a trusted provider of bank technologies, and that same trusted provider who used to provide accounting systems or teller systems or ATMs today can provide you with a mobile payment system. Now you have someone else managing the multi-party relationship. You have just one relationship with a provider maybe you've been using already for other payments vehicles.
Will social site payments really be a game changer for the banking community?
Well, essentially, banks have owned the game for 400 years. Banks were the first ones to make paper money. Banks were the only ones who could get a check from. Banks invented the MasterCard and Visa card and all the other credit cards we have today. They controlled the network, they controlled the merchant, they issued the plastic. So for so long, banks have owned the game that what's really difficult now is for banks to play in a game someone else owns. I've worked with bankers who understand the technology, but what they don't understand is that not owning the technology is necessary to play in this game. Getting over that comfort hurdle and realizing your customers are going to be paying your merchants, but they may not be paying them on a network that you own. They may be paying them on a network that you use. They may be paying on a network you've partnered with, but it won't be the networks that banks are used to using and used to having owned. It won't be the credit card networks. If it is the credit card networks, that's one option. But again, bankers need to be able to look at multiple options. And part of that is realizing someone else is running the game. The game is filled with other players. And it's filled with other players who got there first simply because they were small, they were outside the banking system, they could move quickly, they were unregulated. And that, by the way, is something that we need to understand about regulation. In this instance, regulation is all in the bank's favor. Because when we dug deeper into that data about why people would trust their bank to do their mobile payments with, it was because, well, our bank is regulated. These other companies aren't. So that's part of the game change, is understanding that some of the old game that you have been in that was highly regulated gives you an advantage with your customers, even if it's a disadvantage in terms of your competitors. The next step then is to recognize that it is someone else's game. What can you do in it? What is your unique value to bring to the game? And I like to cite an example of a bank that thought long and hard. They were not first into mobile payments. They have just released their product. Would some say that's too late? Not the way they did it. They designed their product so it is 100% bank-centric. If I make a payment using that bank system on my mobile device to you, and you do not bank with that bank, you are sent a message that says, would you like the $50 that's just been sent? Open an account. It doesn't necessarily have to be at that bank, but the ad comes from that bank. You can go to any bank and open an account, because the transaction between me and you is going to be a bank-to-bank transaction. It's going to go right through the Australian clearinghouse, just like any other bank-to-bank transaction. So that's a way to get into the new game and bring with you the infrastructure of the old game, that not only do you know how to use, but you know how to price.
But where do the opportunities really lie for social banking?
The first opportunity is to realize that it's there and you need to be there. I like to draw the analogy, again, using the fact that social media is a community, and say if you have a site on social media, which most banks do, you can go on Facebook and find almost all the big banks and many of the mid-sized credit unions. They're there, but they're there with what I call advertising. They may see it as community engagement, which it is. It's chat rooms, it's people talking about products, it's interactive, it's all the good things social media are. But the one thing it doesn't do is allow you to make a payment or take out a loan. So what I say, maybe overstating it a bit, is that kind of presence on social media is the equivalent of building a branch in a community simply for the signage on the outside. But no one can come inside and make a payment. No one can come inside and get a loan. So the opportunity for banks is to step ahead on social media sites and actually offer payments and loan applications on those sites. Now, some banks will say, is that safe? And we'll get to that. It is safe, but you have to make it safe.
Yeah, that's really a big thing for banks. When you mention Facebook and social sign-in, that sort of starts a lot of arguments.
The second opportunity with banks is to realize, as banks realize better than I think anyone else in the business does, is that if you hold on to the customer for one of the basic products like payments or loan, you hold on to that customer for all the other products. And that's the real threat. When we see sites on social media where people can go borrow money, and they can borrow the same tens, 20s, hundreds of thousands of dollars that I can borrow from my credit union, we have to realize if I go there to borrow money, and while I'm there I learn I can make payments there, and while I'm there I'm learning they have their version of what looks like a deposit account. It's uninsured, but I may not worry about that. They've lost me as a customer. So part of the thing banks need to understand is some of this is not just to gain the business you can do on Facebook, is to hold on to all that other business that, as I said, banks know better than anybody, comes as part of doing the primary business with that customer.
So here's the big question. Is social media safe for payments?
I'm glad you asked, because the answer is that social media can be made safe for payments, but it's the bank's job to take the responsibility that it be safe. Remember the earlier data. People trust their bank, and what they trust them to do is keep it safe. There are models for doing social media payments that use the well-established principle of data compartmentalization to keep the transaction safe. In a model like this, I could go to a social media site and I could initiate a transaction. I could say, I want to send money to my daughter at college. That message would go to my bank. At that point, the bank would substitute for the screen that I'm looking at, the regular online banking screen that I've already established with that bank. Now we're inside the bank. Now it's a secure transaction. The transaction will actually move as a bank transaction on the bank rails. I'm still on my social media site, but I'm in a pop-up window or I'm in a screen substitution for my bank's site. And the social media servers aren't keeping that screen in front of me. My bank is keeping that screen in front of me. At the other end of the transaction, the same principle applies. That transaction will have moved from my bank on the bank-established channels to the other bank. It will have been verified. It will have been put in the account of my daughter that I'm sending it to. She'll be on Facebook that night, and there will be a message from her bank saying, Daddy sent some money. Now she goes, again seamlessly, via Facebook to the online banking site she's established with her bank and checks, yes, the money's there, and moves it to a different account or buys a dress or who knows what. That's the way to make it safe. It's tried and true. It's used in mobile payments. And the answer to your question is, yes, social media can be safe for banks, and it's banks' responsibility to make it safe.